If you're thinking of buying a property in the UK, I want you to stop right now and think about what you're doing.
So right now, Samuel Leeds put out a video about where not to invest in 2024. And I want to use the Deal Sourcer Deal Challenge to disprove Samuel, to show that Samuel is wrong. Of course, we all know when it comes to property investing, the three things that matter the most are location, location, location. If you have a superior tool to discover value in any area in the UK, such as Dealsourcer.com, then you can find the odd deal. So sometimes when an area is extremely unpopular, it actually means that that's where the biggest opportunities are. So let's see whether we can find deals in the areas that Samuel Leeds thinks are the least attractive in 2024. But before we go there, let's see how Samuel puts it.
As important as it is to know what to invest in, it's also important to know some of the danger zones where potentially not to invest. In this video, I'm going to give you the top 6 places where not to invest in property in 2024.
So yeah, if you're like me and you have a financial death wish, a craving for going bankrupt, then let's see whether we can disprove Samuel, right? And see whether we can find actually deals in the 6 areas that Samuel says are basically impossible to find good deals in.
So at number 6, I'm going to say Blackpool. Blackpool, back in the 50s and 60s, it was the crown jewel of British staycations. Millions of visitors every single year used to go to Blackpool on holiday. But let me tell you why right now I think Blackpool is a dangerous place to invest. Firstly, the huge decline of domestic tourism in favour of overseas travel has hit Blackpool hard. In the last few years, the number of visitors has significantly decreased. This reduction in tourism has had a devastating impact on the local economy. Many hotels and B&Bs have struggled to even stay afloat, leading to closures, job losses. Local businesses that once thrived in the influx of tourism have now seen a significant downturn in trade, contributing to a 3% decrease in property values over the last year. And the average house price in Blackpool is now about £135,000, a reflection of the economic struggles the town is facing. Can you make money in Blackpool?
All right, I opened Deal Sourcer Deal Search. I selected Blackpool. We have 1,262 deals. As Samuel said, there's an economic downturn, and that usually means that house prices collapsed and that people are not really finding tenants and it's difficult to rent out and so on and so forth. Everything that goes with it, rental demand collapse, rental price collapse, all of that, okay? So the most likely deals that I would probably go for are refurbs and negative equity deals, because if the house price goes down, people are underwater in negative equity. So I'll just hit negative equity. Okay, there's a few things I don't like under offer, subject to contract, and we have a beautiful filter here. So leaseholds, auctions, all of that quirky stuff, filter it out. And I have a few negative equity deals here straight away. These ones with the little diamond, they have been on the market for more than 12 months. So the person trying to get rid of that deal, property, whatever you want to call it, is under stress, okay? So I would click into this. I would do a quick review here. Okay, it says overvalued, but it was sold for 89k, it's on the market for 80, so that's around 10% below. The value estimate is 77. Not a great deal, so I would skip that one. Go back. Let's look at this one. A 5-bed flat, sold for 220, and it is on the market for 190. That's not amazing either. 3-bed house, potential PLO, LOA. So it's been sold for 121. It's on the market for 100. That's better. I like that. 100 divided by 121. You can see that's like 20% below. And the value estimate of 110. So that's selling below value. It has an ROI of 9% here, and it's been on the market a year ago, so there could be some potential distress. That looks really nice actually. There's no much refurb. Well, maybe there's some paint and stuff, but like the floor looks good, the kitchen looks modern. Yeah, there's a little bit of a refurb required because of the way, you know, the paint is and so on and so forth. Yeah, there's a slight refurb required, but it's not in a bad condition overall. All right, you put in 29K. Yeah, I would probably say more like 39. So you probably get it at value after the refurb. The rent range 700. That seems on the lower end for this area. Yeah, I would say you could probably make a nice PLO deal here, make maybe a ROI of 10%, and you could hope for the area in Blackpool to come back over the years and add some capital gains to it. This was sold for 121 in 2007, and 2007 obviously was the peak of the market, and that means since then prices have gone down, so this is very likely underwater or close to underwater in negative equity. So the capital growth, as you can see as well here in the last 5 years, has been 28%. So, you know, maybe this has been in a slight uptrend, but that might be a good trend, and we might be able to buy this at a very favorable price in the future. So I definitely wouldn't say that this deal is impossible. So that kind of debunks a little bit of Samuel's story of Blackpool being the worst area. I know that Samuel said you will find the odd deal, but it's a tough nut to crack. Maybe that is one of the deals that you can get. So maybe, you know, it's not financial suicide, God knows.
Now, on to number 5. In the last year alone, prices have dropped by 3.4%, making it the biggest faller amongst the London boroughs. The average house price right now is around £396,000. And Croydon has a very low rental yield of around 3.2%, which is terrible. And that is why I'm listing it at the worst investment areas, number 5.
So I'm in Croydon here. And all deal types, we have 370 deals. We have a lot of HMOs here. Let's see other deal types. We have a lot of flips here, negative equities. We have a couple. All right, let's go for a refurb. Let's see this 40K profit deal here. Well, that's way low, 40K profit on a 500K investment. So we would... Now we can sort in that. That's really high, 300,000 profit on a 450K house at fair value. Just looking at the pictures quickly. Yeah, it needs a refurb, you can tell already. Bum, 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 bum. So yeah, we need a refurb. Yeah, we need to use the deal analyzers that are just about to be released. I can open them, you can't. But I'm not going to do that right now because we're still developing those. Just look at the deal from a you know, bird's eye perspective. So it's about selling at fair value. After the refurb, the price per square meter of this deal would go up to 4.8K. If that was true, the end value of that refurb property is roughly 900K, which is an uplift of 100% from 450K. Okay, like we can have a quick look at similar properties. Okay, they're not super close, but let's just have a look at one of them. This property is in good shape, in pretty good shape, but not in pristine shape. So yeah, probably could be true that we're making, let's look at this property, that we're getting 4.8. Doesn't really matter. This is not in great shape. This is like, this needs a refurb. This is old. So yeah, maybe let's say for the sake of the argument we can get 4.8. So we'd sell it for 900. That's 100% uplift. But this is a 183 square meter property. 183. I don't know if we have to invest 500 per square meter to get it up to scratch. You would have to probably invest around 90k. Yeah, see, actually my refurb estimate, I didn't even see that we have it in here, of 500 per square meter, 529. I'm approximately right. Investing is about being approximately right rather than exactly wrong. So bridging loan, interest and so on, you need a total cash in of 250k, unless you have 250k sitting around. Obviously, you need a joint venture co-investor, and then you can sell it for 900 after the fees, after the bridging loan, after the interest and everything. 300 is the flip profit. Probably a very good deal, given that Samuel said that Croydon is a terrible area.
Number 4 is Reading. Especially with the implementation of Article 4. Article 4 directions have removed a lot of permitted development rights, making it very difficult for property owners to convert your houses into HMOs without getting full planning permission. And the Reading Council are notoriously bad at giving planning permission, which has significantly slowed down development projects. It's added to the costs and the hurdles for property investors, and many local developers have shared how these restrictions have affected their ability to create profitable HMO investments, contributing to a decrease in property values. Again, houses have been dropping in Reading. They've dropped by 2.8%, with the average home now costing around £360,000.
Right, we're in Reading right here, and as Samuel correctly said, there's restrictions, Article 4 and so on and so forth. But that being said, if a property is already an HMO, you need to comply with Article 4, but you don't necessarily need to apply for Article 4. So it's already let out as an HMO, so you can just go with it. So that's what I did. I sorted Reading for HMO as a deal type. I sorted by ROI, and I found 4 deals, and they don't look particularly good because they're overvalued and the cash flow is really low. An ROI of 5% is not something I would entertain for a HMO, and this only gets worse and worse and worse. So 4% ROI, okay, it's undervalued. Maybe I can do something along those lines, but it's not really exciting. So while I can find some deals, some HMOs in Reading, I don't find them exciting. So that's one for Samuel. I have to say it was really difficult to find anything in Reading.
At number 3, we've got Hemsby, which is in Norfolk. Quaint coastal town, like other beautiful landscapes, peaceful lifestyle, charm of seaside living. However, Hemsby has been severely affected by coastal erosion, and in recent years, several properties have literally been lost to the sea, including dramatic scenes in 2013 when 7 houses fell onto the beach. So the average house price in Hemsby is around £220,000, which is a little bit less than average. But for houses directly on the erosion line, the values are getting closer and closer to zero. Hemsby definitely had to be on the list of a very dangerous area to invest.
Next up is Hemsby. So what I thought I can do is, if I don't want to take on the risk of having a property close to the sea that gets swept away by the sea, I could get a property that's further inland, or I could simply avoid the whole thing of owning a property. I'll do a renters A deal. To be honest, in Hemsby itself, which is a smallish area, if I go all deals, there is no deals. So all I can do is go close to Hemsby. So I did the renters A strategy because I don't want to take any of that risk of ending up with my house in the ocean. And yeah, I could find something there. I have a deal, that's, if I go back quickly, that's close enough to Hemsby. It's not terribly far from Hemsby. And if I click into the deal, it's a renters A, the nightly rate. Here on the lower bound, here's all the nightly rates. Took the lower bound, 70% occupancy. I'm not sure, I'm not an expert with Hampsby, but gross rent of 3K. And you have all your platform costs, all the other rent to landlord cost, and so on. This, by the way, is on Rightmove. You have a deposit, you need to dress it up to rent it out. It's not in a great condition. It is in a good condition, but you need to dress it up still to rent it out. You make a cash flow of 16K a year, which is an ROI of 284%, or a payback period of 5 months. So that's under 6 months. It's always a good thing to have a payback period of under 6 months, because that means you're de-risking your rent to SA quite quickly, and after 6 months it's really just pure cash flow into your pocket. So I would say that's kind of like, you know, Hampsby difficult, but close to Hampsby you can get something.
Number 2 is Covent Garden. Now, this will shock you, okay? Covent Garden has seen a staggering 27% drop in property prices over the last 5 years. Every year just dropping. The average house price in Covent Garden is still high at around 1.2 million. Bear in mind, it's dropped 27% in the last 5 years. The average rental yield is 2.7%, which is probably the least attractive area for property investment in the entire country. The average rent for a 1-bedroom apartment is around £3,000 a month. For a 2-bedroom apartment, $3,500. But to buy a property in the area, I mean, you are literally going to get a 2% return investment, which is probably not even going to keep up with inflation. Rental demand in Covent Garden is considerably lower to other central parts of London. Serviced accommodations are regulated there. And if you buy a property there, it's very likely to continue dropping. So I'm out. Covent Garden, I'm out.
Covent Garden, I personally love Covent Garden. I used to live in Covent Garden, but yes, it's really pricey, and despite the prices having come down like 30-ish% over the last 5 years, the yields are low, and I really tried. And again, as Samuel pointed out, restricted for short-term lets. So, you know, you have this 90-day restriction, you have planning permission. That makes it really complicated. Even if you find some nice rent to SAs on here, might be difficult to get one. Everything else, like refurbs, was just very, very, very difficult. I think Samuel is right here. It's not a great area. Can you find the odd development deal? Probably, but if I sort here, for example, on refurbs, I have to go outside. I'm already here in Marylebone, so that's not really Covent Garden anymore. All deal types, yeah, I find the renters A's deals, but like as we said, it's restricted. I really tried. I find Covent Garden incredibly hard.
Next, number 1. Worst place to invest. My least likely place to do a financial freedom challenge, where it would be the toughest, would be Aberdeen, Scotland. Over the past few years, house prices in Aberdeen have declined by about 7%. And that's mainly due to the downturn in the oil sector and broader economic challenges as well. The average house price in Aberdeen is around about £160,000. Aberdeen offers, better, certainly better than Covent Garden returns. Scotland has different stamp duty rates and different tenants' rights, with much stronger protections for tenants. Also, Scotland has implemented rent caps and eviction bans to protect tenants. So, Aberdeen, I'm saying, is probably my least favourite area to go and invest right now.
I have to give it to Samuel, similar with Aberdeen. Aberdeen is incredibly difficult. If I turn on the filters here and I select those and filter those out, yeah, I do find like HMOs, a few of them, but if you click into them, it's difficult. You have actually an ROI here of 16%. It's overvalued to some degree, so yeah, I'm not sure how correct that valuation is. You need to do some real in-depth work to figure out whether you're buying this for too high a price or whether you can negotiate on that 148 and get it down to a value that's more in line. That will obviously also pump up your ROI. This deal, potentially, it could work out, and then you can see it here, rental growth minus 20% last 12 months and a capital growth minus 20%. So, that's never a good sign. Rent to rents, couldn't even find any. Refurb deals, very difficult to find. negative equity. I couldn't find any. I found some, but they weren't really the kind of deals that you want, because you would cut it so close on the RI front. So that means that you propose the PLO, you lock it in, but if your RI or your cash flow is so small, you have such a small margin, it might be that you take on a property for a long time, especially if the rental growth demand goes down. Then you're stuck with the property and you actually have a negative cash flow per year. So that's definitely not something I would go for. So yeah, you could get something in Aberdeen in an HMO style situation, but with that rental demand fluctuation and that rent fluctuation and that value fluctuation, I have to agree with Samuel, it's pretty tough. I kind of think that investing is always going where the others are not. So it's the combination of having a great tool, knowing what you're doing, and not ruling out things like across the board. You have to really go into the deals, analyze them, and you have to, most importantly, know what you're doing, have local knowledge. So you can't like go with broad strokes here. You really have to know what you're doing. And actually, I agree with Samuel. So let's hear Samuel's conclusion. I think that's probably the truth here is you need to know what you're doing.
It's really important to note as well, just because an area like Covent Garden, for example, might be terrible for buy-to-let, it might work for something else. Maybe development opportunities. Or it might be that Aberdeen might be really bad for one thing, but could be good for something else. So I wouldn't rule off an entire city for property investment altogether. Important to just choose the right strategy for the right area. Let me know in the comments. Don't forget to like and subscribe. I engage and interact and listen to all of your comments. And if you've got any more ideas that you want me to do to shoot a video on, you've got thoughts, comments, questions, let me know below. I look forward to reading your comments, and I'll see you next time.